Well, howdy folks, let's talk about gas again today. I'm just going to scan through the news. There's not an awful lot. We can talk about things like Texas GOP proposes adding 10 gigawatts of natural gas-fired backup generation, traders unloading LNG at discounts. Interesting that, as it says here, labor strikes continue to impact LNG import terminals and upend energy flows in France, which is being forced to tap into its own stocks as vessels held elsewhere amidst disruptions. Strikes broke out last month, etc. Not an awful lot on this site. This is Natural Gas Intel. And then Natural Gas World, one or two interesting articles, but these are not the main stories. The main story is actually the charts that we want to carry on looking at, and the charts are quite interesting. So we'll go across to those shortly. I don't know how you pronounce this. Iberdrola to sell gas assets in Mexico for $6 billion, and then exports to Europe from Gazprom recover in March on higher Ukrainian transit and that sort of thing. Deadline for sale of foreign shares in Russia's, again, pronunciation, Sakhalin 1 extended, and a bit of energy news out of Russia and Qatar. So, not an awful lot. And then if you look at the weather maps over the US, for example, there's not an awful lot going on there. It looks like pretty fair weather to me. I don't pay a lot of attention to forecasts, but a lot of people do. The weather changes all the time. It has an impact on the sort of short and medium term price of gas, I suppose, in terms of usage and consumption of gas for heating and so on. But when we're at extreme price levels on the charts and so on, as I said to someone before, we're not looking so much for things like fluctuations in the temperature, the weather, and minor influences on supply and demand. At this point, we're really looking at what's going on at around $2. So I think the best thing is to go and have a look at the charts. So here's the chart of natural gas, and it's an interesting chart. You can see, actually, we've been going sideways since probably around about the 21st of March. That's when we dropped for the first time into this $2.20 to $2 range. And then ever since then, we've been moving sideways, gapping up and gapping down as the days and the weeks go on. So we're still stuck in that range. There's one thing about tight ranges, and that is the longer they last for and the longer the period that the price sort of coils up in this region, the more explosive the breakout's likely to be. So it can only go one way or the other, I suppose, and that's either up into some of these resistance levels or down into some of the support levels below us. And also, the longer it lasts for, the more likely it is that this level is going to break down. So watch out below us at $1.80 and $1.50. I've got these drawn in on the chart a little lower down, and there's the 180 and the 150 level below us. So whether we're going to have a visit and a dip down to those levels or not, I don't know. But the longer that we do stay in this range between $2.20 and $2, the more likely it is, I think, that we're going to break down rather than break up. But I don't think it's tipped in the favor of the short direction too strongly. If I was to choose a range breakout direction, it would probably be down. But on the other hand, it could also be up, and I think it's slightly weighted to the downside. But that having been said, let's have a look more closely at what we're seeing here in this range. So we're seeing frequent gaps down and gaps up within this range, meaning supply gaps within here, indicating a lack of liquidity within this range. No real desire for this market to actually move up or move down. We're seeing gapping from time to time, which may indicate a lack of interest in taking a position to the short or to the long side. Let's have a look at where the candle wicks are. We saw a few days ago at the end of last month, a few wick highs, and the market rejecting off that 220-ish level. It's actually at about 223. And you can see I've drawn the top of this range, kind of cutting off the wicks, and I've done the same at the bottom. The wicks are not the most important part of these candles. We're looking for the candle bodies and where the market actually closes after each one of these 4-hour candles. And they've all closed within this 223 to 206, 205, 206 range. We've seen a couple of spike lows or wick bottoms as well, going back a few days ago. We actually saw one yesterday, the last time we visited that 205 to $2 range. So I would say this is incredibly equally balanced, and you know my position. I'm long from just about $2. Let's call it exactly $2. It's a small position, and I'm willing to add to that position if we drop down to $1.80 or $1.50 below that. I think that's about as low as this price is likely to get if we do get down there. I don't know if we're going to. That's why I've taken a position where we are at the moment, just around about $2, looking for a break up through the top of this range and then a move higher. Look where the 100 period moving averages on the 4-hour chart, and the 200 now just above us in that top range. And At the moment, as I'm recording this, we're just slightly above the 20 and the 50 period moving averages. As you might know, when trading natural gas and most commodities, I prefer to look at the day chart. And the day chart shows us a very similar picture, except that where the day candles close is more important, obviously, than where the 4-hour candles close. Yesterday we had a somewhat bullish candle, more of a hesitation candle really. And the 2 previous days, also these sort of spinning top tiny star doji candles. We had a couple of days of up and down before that, and really nothing to be gleaned from the day chart except that we're just traveling sideways. We're below the 20 period moving average and this range top. We're also below the 50 period moving average and the next range top. And below us, as you can see on the day chart, is the $1.80 and the $1.50 levels, ever beckoning and calling natural gas to move down towards them. So what does that leave us with? Nothing really. We've got our position open, $2 long, willing to add to 180 and 150 below us. And first objective is to break up and close above this current range at around $2.23, and then move up towards this range here, break through the 20-day moving average, and then move up to the top of this range, which is where the 50-day moving average is, and then eventually to break up, hold, back test against there, and the same wash and repeat as we move higher and higher up towards $3. $3 is going to be the big challenge to get through if we're going to reach our target of $3.40, 50, 60, or 75. And the reason for that is because it's a big round number. We had a lot of supply there after a massive move down, 2 huge candles, a big gap down after that particular weekend on the 6th of March, and then this progression downwards from there. So this is going to be the big number to get through. Let's not worry about that for now. Let's think about the levels that we're at the moment that we need to get through first. And that's above 223 and then above 243 through these 2 moving averages, which are now starting to bear down upon us and which are squeezing us into this corner. If you want to, you can also draw a descending triangle here by drawing a trend line roughly through these highs and then comparing that descending trend line to this bottom. You can see it's a flat bottom with a descending triangle top. And that's potentially a bullish chart pattern. And think of it like this. We've got all of this supply squeezing the price. In this case, it's to the short side, squeezing the price into the corner of this sort of toothpaste tube. And at some stage, when the pressure from behind in the wide part of the triangle becomes too much, it forces the price out, not of the nozzle, which it would be if this was a toothpaste tube, but sort of through the casing of the tube, and that would be either up or down. The good news is that this pattern, although it's a little bit of a stretch to draw it like this, is actually a descending triangle pattern. And that's a bullish pattern on any chart. So there is perhaps more potential for the long side than I'm actually giving it right now. But I always remain a skeptic when I enter trades, and I always expect the worst and prepare for the worst and plan for the worst. In my case, the worst is a breakdown to $1.80 or $1.50. And when I say worst, actually it's going to provide me with a better opportunity to get in and fill my position up, because it's only a partial position at the moment. I want to complete that position by buying at lower, cheaper levels, thereby maximizing my profit potential if we do then manage to hold above those levels and break up towards our target of $3.40, 50, 60, or 75 into this region. I'm going to illustrate my current position on the Oanda demo account. So let's have a look at that right now. So this is my Oanda demo account, and this is indicative of the positions I have on the futures and also on my live Oanda account. They're completely different instruments, so don't get them confused. The Oanda price here, which is a sort of made-up price by taking spot and futures prices into consideration, and then the actual futures prices, which I'm trading on my main accounts. But this entry price here at around about $2 is illustrative of my positions both on Oanda and on my futures trades. You can see my entry price there at $1.98. I actually got in right at the lows, fortunately, and we've held above there quite nicely since I entered the trade a couple of days ago. We're now at $2.06, $2.06 on this chart. My profit is currently $308. And if I just move this little tab up here, you can see there's the profit, unrealized profit of $308. There's my position. My take profit on this one is $3.50. My futures at $3.57. Not that it makes a big difference. And my stop loss is at $1.37. We're now 7.7 pips in profit with $308. So this is the account that we can track in terms of these trades. Remember, I'm willing to add to this position at $1.80 and $1.50. My stop loss for all of these trades will be at $1.37, as you can see right there. Well, so far so good. I hope you found that useful, and I'll continue to update every couple of days. Right now, there's not an awful lot to add to what I've said before, but at least it's an update for you to keep an eye on. If you enjoyed this content, please take a moment to like the video and consider subscribing to the channel, and make sure you press the notification bell so that you get updates as soon as I upload new videos. Have a great day.